Hello, everyone. Welcome back to the Frivolity. Another FOMC meeting day. We have on the screen here matrix. Things should get a little bit crazy here when the actual announcement hits. I'm not exactly sure how I'm supposed to do this. Am I going to load the FOMC meeting on my own computer over here? And if this thing is playing, can you hear? I guess you can't really hear the audio, eh, Chris? Like, can you hear that music? Okay. Okay, so if I just, when you can't hear anything. All right, well, I'll try and have myself on mute, I suppose, while Jerry's speaking. Welcome back to the Frivolity. I'm a little choked here this morning. I got stopped out on the Bitcoin short that we had because I had it like at my at scratch, which was my average cost there. Literally, they rallied it right into Mountain Man, everything that we do on the site, and this rally stopped. I'm a little pissed off at myself today over that. Although this chart might be hard to see. But we'll see how it goes. It would not surprise me if this fires an inside bar and we continue our way back down. This was a V bottom. V bottoms need to be tested. And of course, around FOMC meetings, I trade terribly. It's consistent. In fact, actually, I even told myself no futures trading this week as we're going through this Fed because I always get torn apart. So anyway. Point of the matter here is we dead cat bounced right back into resistance and we're basically stalled out here on BTC. Was able to survive the counter trend rally there on Ethereum. And I did put out a tweet the other day basically saying that, it doesn't really get much more textbook than this. Looks like the press conference is starting, eh? So I'm not quite sure what they're doing. Is Jerry supposed to speak right away? I didn't think he started so early. Oh, they did. Well, that's interesting. I didn't really see much movement in the market. So what's the headline? Wow, isn't that interesting? I mean, as FOMC meetings go and the amount of volatility that we usually see, I mean, this is almost like there's no reaction at all. Anyway, here comes Jerry. So do you have like the little video down in this window down here?
Anyway. Good afternoon.
All right, there he is.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, Private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December, really, and we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis.
Oops, you just spilled the beans.
Applied. I don't know that. I think I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick Tamarosa of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
So as far as the SEP part of that is concerned, As you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I don't really, I can't really distinguish between two of these. They're so close for me. These are very close calls. But we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around one or two. So I think I would look at all. I look at all of them as plausible, but I'd look at so I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly, more good inflation readings will help with that. I'm not going to be specific about how many because, really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident, have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that, and we see today's report as progress and as building confidence. But we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after
Look at that Russell
8:30 or whenever
2000
you
puke
got
out.
the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't. Most people don't. And I'm not going to get into the specifics, but you have the ability to do that so that what's in the SEP actually does reflect the data that we got today, to the extent you can,
Somebody
reflect it in one day.
selling.
I think we'll see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its kind of first level translation to PCE we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
John Allen.
Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen
Look at
wage
crypto.
increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 6/10 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit, it's softened a bit, and you know, that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still, they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand. And that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago, or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year. And as I mentioned earlier in the, what did we take away from this? We had really, really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was
Ethereum, but I'm pissed off about this
to
damn
get the confidence
Bitcoin.
that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. There are fewer rate cuts in the median this year, but there's one more next year. So if you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. The economy has repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina. Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. How should we interpret what that means about how the committee views its current policy setting?
So 2 things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question.
Are you sure this is about the pandemic, or is this maybe about the Great Reset?
That rates are less likely to go down to their pre-pandemic levels, which were, very low by recent history measures. Now, we can't really know that. That's an interesting dispute and discussion to have now, but ultimately, we think that things like the neutral rate are driven by longer run, slow-moving forces, and there's a really good question about whether those really have changed, or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about looking at the incoming data and asking how much progress are we making on inflation, and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on, we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal, and then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that, though. We're look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that, you know, since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but, you know, no one has that as their base case. So no one on the committee does. But so that's you know, that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation, with growth at a good level, and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and you know, that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market, while we're continuing to make progress on inflation. So, I mean, we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
On housing, you know, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. I mean, ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, you know, low mortgages. In terms of banks, the banking system has been, you know, solid, strong, well-capitalized, lending. You know, we've seen good performance by the banks. We had the turmoil early last year, but, you know, banks have been focusing on bringing up their liquidity, bringing up their capital, and having a risk management plans in place. So the banking system, you know, seems to be in good shape.
Chris.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, you know, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, you know, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, you know, and I think you can see it in various places. You know, in some parts of non-housing services, you see elevated inflation still, and that's probably to do with, it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and, you know, we've taken some signal from that, but you know, and of course, housing services, you're continuing to see high readings there. To some extent, that's you know, catch-up inflation from earlier pressures. But I mean, overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, you know, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, you know, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy, what you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years, and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. You know, really the whole rate path matters, and I do continue
stocks
to
are
think
happy
that
again.
when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully. And we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We you always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably on 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction. But one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Jolene. Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
I don't think anyone knows, has a definitive answer why people are not as happy about the economy as they might be. And we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people who are at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year, and I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well,
God.
I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest
Ooh, I
further
like her.
progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, particularly the second half of last year, and we continue to see still strong growth or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that, and that's not what happened. Instead, the U.S. is anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about. Your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there are renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents that has to get worked off, and that may take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It just is going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it.
You will
differently
own
than
nothing
us.
and
It's
be
something
happy.
That the price experts have regularly looked at. It is not something that we're the only country that does. And it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward.
Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home. But households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And, what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as they're spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right, though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done, ultimately to get inflation under control, because those people experience inflation, very directly, very painfully. And once we get inflation under control, rates can come down, which will also improve things.
Victoria.
Hi, Victoria Guida with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move and to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So. And also the fact that we look at all of the whole situation. So, a decision to begin to, loosen policy could have several reasons associated with it at a given time. But I would just, we monitor all the labor market data, and if we saw troubling weakening more than expected,
natural gas
that would be
topping out
something
here.
we'd consider responding to, but we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I can think of things many things would make it on that list, but I don't think I'll utter them here.
Thank you, Chair Powell. Simon Urbanovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that it looks like May will be quite good for PC as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
I don't actually have that kind of mechanical thing in my thinking. I
These
get
media
that,
people all
as
desperately
many
need
good
these
ones as
rate
we had
cuts,
bad
eh?
ones, but no, it's not like that. It's going to be the totality of the data, the labor market data, the growth data. In terms of inflation, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things, because that points to dates, and I just don't think we're not at a point of being able to do that.
Kosuke.
I think that was the telling
I'm
statement.
Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that the market should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't. Actually, it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, and for our economy, what we're trying to foster is maximum employment and price stability, And we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer.
Dodge.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE, or at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once? You're well above neutral, to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation.
You know, so we're well aware of the two-sided risks here. Let me just say, we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is, you know, an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there. And
don't expect rate cuts until you see the labor market break.
We have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low. So we have the ability now to approach this question carefully, and that's what we're doing.
Just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Evan.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year.
Look at the Dow
At this point,
go.
do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing, and all the other details. We don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't. There isn't any one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example, and we don't target wages. We target aggregate prices and overall employment. So,
But if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you look at we'd be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
And that's all she wrote. Well, I hope you guys enjoyed the edutainment. Suppose we can do a quick summary of what we heard. And I suppose what we're seeing here also too in the market. Is anybody even still there? I have the FOMC, but I don't have our stream. I don't know whether anybody's actually even watching this or not. Hope you guys enjoyed my color commentary through the broadcast. Is everybody ready to eat bugs? I think we got another reiteration that you will not own things, you will be happy, and of course you will eat the bugs like good little robots you are. Let's see what we got here. Is anybody over on YouTube? I was watching the FOMC, watching Jerry squirm there. Actually, I don't know. It would be interesting to get like sort of a barometer reading on what you guys sort of felt like. Hey, there they are. Okay, I got the YouTube page up and running here. Ed says maximum employment and price stability. The Fed is committed to reaching its target goal of 2%. That's very well stated, Ed. You could be a Fed governor yourself. Actually, I wouldn't be surprised. Ed would actually make a really, really good. I could see you out of the San Francisco Fed, Ed. Ed is a Fed. Yeah, there's a poem in there. A poem, something like that. Anyway, let's see. Thomas says, yeah, maybe market was a little bit hasty today. And I did kind of notice that. I mean, they really sold the US dollar off like crazy there on that inflation print. And frankly speaking, when we were talking in the daily brief this morning, at least I was talking, I don't know whether anybody else was listening or not. That data it wasn't sort of like, oh my God, let's all go party. Woo-hoo, it's the best. Yeah. I mean, it was just sort of like, basically in line with expectations. I did hear Jerry say there a few times that they were thinking about lowering interest rates. They were on that path, and then that first quarter data just completely derailed them. And we've been talking about this for quite a while at TRI, so it's really not like anything shocking. I often use this market-based tool. I don't like listening to the government bureaucrats. I think they're all full of horse hockey. And of course, 9 times out of 10, they're politically motivated. But this is our favorite tool that we teach in the education program, the TIPS versus the TLT as sort of your inflation deflation gauge. And you can clearly see that, first quarter, we had a major push higher here in inflation. So much so that we actually got to the point where we were threatening to challenge the sort of scamdemic inflation peaks there. And really, I guess the question you have to ask yourself is why? And, I've been trying to convey to our audience the significant role that energy plays in our society. And, if we look at the energy markets and how they've behaved, where would be our energy over here? Got several different screens going, so sometimes my head explodes here. But, this energy market was just, ironically enough, as an old commodities broker, this is actually just so business as usual. It's not even funny. But, the commodities trade goes, the typical seasonal trade, buy your unleaded the middle of February, You sell at the middle of May, you made money 9 out of the past 10 years. I mean, this is interesting. There's the middle of February. Here's the middle of May. I mean, technically, I suppose it was up. If you did time your purchases a little bit better, buying W's, selling M's, or even this M, I mean, you made some good money. And this is actually very normal. This really isn't anything out of the ordinary. And I've suggested to all of you that the easiest way for you to follow inflation is simply follow what the energy price is doing. And I also said too in the video today that there is quite an element in our society that would really love to change this narrative, break this model. Of course, everybody wants us driving electric cars, and Fink and his ownership of Tesla stock and how he sort of distorts all of his minions and all the people that work for him in the press. Did you see that CBS reporter? My God, was she ever a piece of work, eh? And I actually had to come off mute and openly laugh because she's like, okay, so can you tell us exactly the date you're going to cut interest rates? And it's like, who let her in here? Oh, no, that was hilarious. My favorite girl, for whatever, on the record, my favorite reporter in that whole group is the British lady, and she is sharp as a whip. I would not try and put anything past her. I can't remember what her name is. I think she's from the Financial Times, and I love listening to her questions. She always puts him on the spot. No holds barred with her. She's awesome. But that CBS reporter, my God, what a piece of work she was. Oh, goodness. She could have her press pass revoked. You don't ask exactly the date that he's going to change policy. That just doesn't work that way. Anyway, so, what are the takeaways? I like to watch in the short term, and this is sort of like a 3-minute chart. Just try and get this sort of knee-jerk reaction out of people, firstly on the actual rate announcement, rate change, rate non-change, whatever. And of course, today was non-change. And then also too, I like to follow this matrix for sort of like, did somebody say something that the whole market went, oh shit? Like I did notice, and this kind of pissed me off because I even came off of mute and I mentioned it. I actually got stopped out of my Bitcoin shorts here. I had just the prettiest trade, and I don't know what it is. Bitcoin's been really messing with my brain here lately. You can see I was short the futures up here. I didn't get back in on the futures short. I had a cash market short. And anyway, I got stopped out on this move here. And my rules are if the market goes to 50% of my anticipated move, I have to move my stop to scratch. Just because it's so debilitating if you have a winning trade turn into a losing trade. So I got stopped out this morning, which really pissed me off. And God, this Bitcoin's done this to me a few times now, where like literally right into the pivot, they run my stop and then they continue the direction lower. So I wouldn't be surprised if this actually continues lower here now. They had a good chance to run this thing back up. And what I noticed here this morning, good old Mountain Man. I mean, God, how many times do we see Mountain Man stop the bull? So once again, bull has been stopped. I guess the question ultimately here for something like Bitcoin is, are we going to carve out something like an inverted head and shoulders here? If anything, you don't really like to see that sort of downward tilted head and shoulders pattern. We would have preferred to see that they actually went and broke that market structure high and then consolidated. So because of this, and then also too, I mean, to add insult to injury, right? I was stopped out there. You get 8s and 9s on the time to mark. So, Julian's getting all excited. Oh, gee whiz, as Jerry's speaking there, boom, in comes an M top. See you later. Down we go. So that's kind of a piss off. And if anything, this is a good part about listening to a clown like me, is that at least I'm going to give you the straight goods. Somebody in the daily brief even today said, well, or I guess it was in the lounge before this, they said, well, at least we're not going to get a whole bunch of bullshit from you, Brian. You're just going to at least tell us what real life is like. And I tell you, this is a really good anecdote of real life. Market rallies right into that event, buy the rumor, sell the news, which is so funny because last meeting it was the exact opposite. You remember last meeting it was sell the rumor, they dumped the market hard into the event, and then it was buy the news on the other side. So we'll see how this plays out. I'm not holding a lot of confidence that this right shoulder is going to hold here. And if anything, if we do actually break this left shoulder level, which we're basically flirting with right now, then the head and shoulders, like if we come down to here, the head and shoulders is off the table. Oh, there you go. So look at that. We're already flirting with that low as we speak. So I doubt that this is going to turn into some sort of head and shoulders, but we'll see. Only time will tell. Was able to ride the storm and did not get stopped on the Ethereum short. And as I said at the very beginning of the broadcast, just as Jerry was getting up to the podium there, this is actually a pretty cliche top. Some people would call this like Adam and Eve reload zones. Everything we teach in our education program moves back against horizontal support and resistance. Institutional fingerprints. Where did the institutions actually put the top in the market? And what a big surprise. We rally back up there. And the institutions say, no, I don't think so. Back down you go. So I would prefer to be still in both those trades. Wasn't able to weather the storm, and the Bitcoin got stopped at scratch, so we didn't lose any money. That's good. But still got this Ethereum short working, and if I'm really lucky, hopefully I can just not do anything here and F this trade up. Kind of seeing the same thing in the stock market. The stock market just ripped higher on that CPI number first thing this morning. I mean, it was just embarrassing how strong it was. Wondering whether maybe that was a little too far, a little too fast. That's what I'm kind of thinking here. This is a lower time frame chart of the ES. You can see we were taking short shots here and got stopped against the ATR level, but it does kind of make sense being a Fed day, and this was a paper trade. So I'm not officially allowed to futures trade on Fed days. That's breaking the rules. So it was a paper trade, got stopped, no big deal. But interesting to see, even those people that took short shots up top here, notice right into that Fed event, they went and washed out that liquidity pool up there, and then down we go. And if you look at the internals, they're not really looking very happy right at the moment. So could this turn into some sort of buy the rumor, sell the news, right? So there was our big inflation number that came out first thing this morning. Then we did basically nothing through pretty much the whole day. Then Jerry takes the stand and the selling starts. And, I had even mentioned while that was happening, we were watching the Russell 2000. Russell 2000 is probably a better benchmark to follow because it's like 2,000 stocks, right? It's the whole universe, right? And a lot of the smaller stocks, of course, are much, much more interest rate sensitive. And if you just think about it, Joe Sixpack, you heard Jerry there. I even interrupted, through the broadcast and said things like, you will own nothing and be happy. You heard him say, the 1%, those dickheads, right? They are encouraging our society to basically just become full-time renters. And I did find it interesting that even a large portion of the housing market and the housing industry, they still value how they're doing based on like rent equivalents. So yeah, you own your own home, but who really owns the home? Do you own the home? Or does the bank own the home and you're just pretending to actually be the legal owner of the house. And I have a feeling, Klaus and all his "you will own nothing and be happy." I think that's basically the way the 1% would like our society to move towards, where we're all just swimming in debt. We're up to our eyeballs in debt. And of course, that means that we're basically the bank's servants. There's another colorful word that starts with a B that we would use, but I'm going to try and refrain from swearing. But I might argue that, actually very similar to the way Japan went, we're probably going to have a huge portion of our society that is basically zombies, and I think we're going to have a huge portion of our economy that are, that you've all heard the expression before, zombie economies, right? They're zombie companies. They're carrying so much debt that there's no way they'll ever be able to pay off the debt. And all they're doing is they're just scraping to just try and survive. And I have a funny feeling that that's basically the direction that our whole society is moving towards here in the West. So party, party. And of course, this is music to the banksters. I mean, if you just think about Rothschild, what would he ideally like? Or them, I don't even know. Be interesting to see whether they could inject a female Rothschilds into the equation. That might be interesting to see. I've never seen a female Rothschilds on the stage. Anyway, point of the matter here is, as they were barking away, I was like, keep an eye on this Russell 2000, because that Russell 2000, it's actually given back a huge portion of that inflationary, or I guess disinflationary pop that we saw out of the data this morning. And the old adage is look left. So once we get into this price range, and I suppose if we change this to like a bar chart or even a candle, you see that that's just one candle there, right? So we're in the look left candle. So that means that key support actually is basically right where we were overnight. There's a Rothschild, a female one, is there? All right, thanks, Kevin. It'd be interesting to see if she becomes vilified like her family, or whether they just try and remain quiet. Who knows? Okay, so the point that I wanted to make was just simply that I noticed that the Russell 2000 started to break first when Jerry started to basically say, don't expect any interest rate cuts anytime soon. Yes, we're still data dependent. And unfortunately, the data, first quarter of the year wasn't really all that rosy. Now, the interesting thing about that, and I had kind of made mention, I think, I don't know whether I did it in the daily brief or not. Obviously, this year is heavily politicized, especially in the United States. Did find it interesting that a lot of the European elections have gone heavily in the direction of the conservatives. Did also see too, there were a couple people that were running for office in Europe. One person was in jail and won. So I'm not quite sure how that works. Another person was a social media influencer. So I don't know how significant these European Euro Parliament elections are at the end of the day. But it was kind of interesting to see like sort of the outcome was kind of like a knee-jerk reaction. People are sick and tired of this woke agenda. And you even heard Jerry say there a couple times, he loves the fact that the immigration numbers are basically diluting the labor market pressures. He absolutely, I mean, my country, don't even get me started. It's shocking. I'm not even going to comment on it. It's staggering what's happening in my country. I don't know if it's as bad situation in the United States, but the message that I'm hearing is that, or seeing, interpreting, I guess, is the baby boomers, the sickness was the catalyst to finally sort of kick them out of the economy. And they're officially gone now. So that has left a massive vacuum because Generation X, my generation, much fewer people in the workforce. And then millennials following that, even a smaller cohort. And yet, business, I mean, you heard Jerry talking about the labor market pressures. Jerry, I think the only solution to their problem was just simply open up the floodgates, and the previous demographic makeup of the North American society will no longer be the case going forward in the 21st century. That's probably about the most polite, politically correct way of stating this. The powers that be, the 1%, all those, they're more than happy with that. But the fabric of our society is changing dramatically. No doubt about it in my eyes. Anyway, from an economics perspective, ironically enough, this is actually probably a good thing. Like the inflationary pressures of basically a vacuum in the labor market. And keep in mind, this is all supply and demand. If a company wants to do business and they need somebody on the floor to be sort of that customer service representative, they need that person. And they don't care whether they're white, blue, brown, black, yellow, whatever. They don't care. They need that person. And if there's a limited labor force, well, then they're going to get into a bidding war for that worker, which ironically enough should happen in a normal, healthy economy. So what would normally happen in that situation is this pay that you see that workers are here, Joe Sixpack's wages, they would be bid up and keep pace with this stupid hyperinflation of the money. And make no mistake about it, all this double talk that you hear out of these bankster crooks about what is inflation and what are the drivers, and it's all just an absolute stunning fraud. Why don't these people come out and admit? And if you want, you don't have to listen to the Beamish. You can listen to Milton Friedman, probably one of the most respected economists of the 20th century. Inflation is a function of money printing. It's just simple as that. There's no double standard here. It's really just that simple. Inflation and the rate of pricing pressure for things like the consumer price index, it will just be purely a function of what the slope of this curve is. So, he's getting all proud of himself because, well, they're bringing the inflation into line. Well, that's what this is. And really all they did was they just put the kibosh on printing more money. And, now if anything, the irony of it all is that they've actually shifted the job of the controlling this from the Fed back over to the U.S. Treasury. And it's just going to be a really case of, does the market absorb all of these bonds that the U.S. government keeps issuing as the world hegemony? They drive the bus. You don't want me to get started about like China. My God, this M2 money supply situation in China, it's just straight up. And as a result, there is no control of the price inflationary pressures here. But this isn't about, controlling the labor market and bringing things, supply and demand into equation. This is just simply, they just put the kibosh on money printing because they could see that they were printing ridiculous amounts of money and it was leading to hyperinflation. And he has repeatedly stated, and I think he's spot on, that these Western capitalist, quote unquote, societies, they cannot function in a hyperinflationary environment. Just ask the Brazilians and quite a few South Americans how life went in the 1980s and 90s there for them. I suppose also to a certain degree the early 2000s. So, he's happy that the inflationary pressures are abated. But how do you think Joe Sixpack is feeling right now? So you heard that one reporter talk about, well, why do people not feel very good? And he's sort of like, I don't know. I guess they're just idiots. Maybe they should just go get a job or go get 2 jobs or go get 3 jobs. I mean, the simple fact of the matter is the reason why most people aren't feeling very good is this is the inflation. This is prices in our society. These are wages. They're not keeping up. It's just as simple as that, folks. And the sad part about it is for them to keep up, we actually need to have a huge inflationary push in our society. So, a lot of people have talked about there being a second wave of inflation. There's one social media person, I can't remember their name, but anyway, that talk a lot about there being another. God, I can't remember the person's name. I want to say Lynn Aldridge or Alder or something like that. I don't know the person at all. So, but anyway, I do know that there are quite a bit of social media posts about how there being another inflationary push into the latter part of this decade. If you go back and look at the 1940s, we talk about it extensively at TRI. And my hunch is that inflationary push is Joe Sixpack finally saying, look, we just can't live under these conditions. You have to raise our wages. So anyway, we'll see we'll cross that bridge when we come to it. All right, let's see what we got going on here. So Bitcoin shorts. What a piss off. Hopefully I can get a counter trend rally and get those shorts back on. Although I did say in today's site video, usually the market pivots around the end of June, beginning of July. So I do think that this shorting window is nearing the end of its cycle. But as it stands, it looks like crypto's coming off here a chunk. Interesting to see Euro, Canadian dollar, Swiss franc, British pound. So European currencies selling off against the US dollar. Asian currencies. Interesting. Did you guys hear the Japanese reporter? Sir, can you comment on the strength of the US dollar and how it's absolutely killing its foreign trading partners? We have no comment. And we don't care. As spoken like a true American. Do we have any Americans on the call? I guess, Chris, you're an American, right? I mean, do you really give a fuck what happens around the rest of the world? Right. So I thought that was an interesting commentary because the Japanese yen is just getting absolutely taken apart here. Commodity currencies. If you're a commodity bull, you probably want to keep an eye on the commodity currencies. They didn't perform very well through the whole speech. And interestingly enough, the bonds, which were kind of the proxy that I was kind of feeling like, okay, maybe we're done here on interest rates going up. They actually started to bottom out. Actually had a really cool chart that I was putting together earlier today. I don't know whether I still have it up here or not. I might have gotten rid of it. That's too bad. The bonds themselves, let's see if I can find the bonds. Look at that damn Bitcoin. What a piss off. Anyway, it's a trader's life. Yeah, maybe we can see it here. Oh, you know what it is? Actually, I created a whole new chart deck. Let's see if we got it here. Commodities, there we are. So it's interesting to see, and I actually like doing this. I'll look at the whole commodities market from like a weekly perspective, see if we can see any emerging trends. And here are the bonds. And you can see that on a weekly basis, this is sort of a higher time frame look. It sure looks like these things are trying to bottom out. So yeah, on the short term, that 3-minute chart, you can see that maybe we got a little bit too far, too fast heading into that Fed meeting, and we're having to take a bit of a pause. If we look at the, I suppose the inflation deflation gauge, we were actually pushing to new lows here before Jerry spoke. And you can see that the market right now is kind of going, okay, well, maybe I don't want to go into free fall just yet. We're data dependent. I might even argue that the market itself is probably data dependent. Everybody's watching the data like a hawk here. Let's see, where else did I want to take you here before I finish off? So let's see how this plays out. It's Wednesday, so we still have a couple more days here into the end of the week. My hunch is a lot of these W's are going to confirm. And then really ultimately, we will all know that we are out of the woods when it comes to the inflationary pressure. If you see these massive W's all confirm here. Right now, I might argue, this is the long bond, probably the most sensitive. Over time, I think we're probably just range bound, and we're just going to play ping pong back between these two ranges here. You can make the same argument. This would be a proxy on the Fed, and this is the 2-year bond, which often tracks the Fed. You can see how he's range bound. And actually, this is a good segue because, we need to sort of put everything into perspective. Does it make sense where we are on the economic cycle? Right now, we're actually seeing utilities outperform. And if we look down at where we are on the economic cycle, if utilities are outperforming, then that means we are past full recovery. And remember there about like 6 months ago, remember we had energy going absolutely crazy and all that kind of stuff. We're well beyond that now. We're now into this stage where, they have been raising rates. Market's been sort of it's interesting that we live in this sort of nifty 50 economy. I think probably to get a reading of this orange line, market bottom, we probably should follow the Russell 2000 as sort of a bigger, broader benchmark. Sadly, in our current economy, there's about like 4 or 5 stocks that are heavily skewing the data. So, just these 3 companies alone are bigger than the entire financial services industry. These 3 companies are bigger than the whole damn, credit card market. There's Berkshire Hathaway in there, for Pete's sake. Where's the energy? Like, this is the oil patch now. I mean, when I was a kid, the energy market was as big as this technology sector. Look at this. You could argue that Apple Computer is bigger than the entire American oil industry. So, unfortunately, when this is this nifty 50 kind of economy that we're in right now, and I think they've said something like, I think it's like the top 25 companies or something like that actually represent like maybe not. I think it's like the top 5 companies represent something like 20-30% of the entire US economy, which isn't really that healthy. And I did make the argument in the Daily Brief today that I actually like the idea that maybe regulators will start thinking about breaking up these companies because they're just getting too big. This is just, back in the 90s when Microsoft was as big as this before, they actually did try to break up Microsoft. And I might argue that, there's several different sort of components of Microsoft that really should be independent companies, but that's the communist in me talking, I suppose. So where do we go for forward from here? I wouldn't be surprised. This 3-minute chart, of course, this is a very short-term myopic kind of look. I really wouldn't be surprised if at the end of the day and looking at all the data that today actually becomes kind of a hurry up and do nothing kind of market. And I suppose probably looking at the stock market, the ultimate leading indicator for the economy, there's the Dow. So we're well off those highs. We're well off the lows. Yeah, we're kind of bumping around reload zones. Probably this W down here probably represents support. Russell 2000, kind of backing up. Not as bad as the Dow. Keep in mind the Dow has oil stocks in it, has the financials, all that kind of stuff. And then, of course, there is the NASDAQ, Nifty 50, and I think the S&P 500 is actually almost like you can see that the S&P 500 is actually following a lot along the lines of the NASDAQ. So it's not really like anything's breaking here. I would consider this almost just sort of business as usual. And I'd also say too, we'll probably finish off with this comment. If we look at something like the total crypto market cap, still looks to me like this thing is just going sideways. I don't really see a crash here. And one thing I will say is, we've been working diligently over the past few years to try and bring this breadth indicator back or like online. It crashed earlier in the year, so we had to rebuild it. And it looks like it's giving some pretty good data here now. It is interesting to see that crypto now is actually flashing oversold conditions on both the short and medium term. Ironically enough, from the stock market perspective, the S&P is just doing nothing. It's not even really overbought or oversold, just sort of bumping along. So the weakness that you've seen in crypto of late, I actually think it's seasonally normal. I don't think it's the big boys, right? These big boys, they're, trades aside. You look at this Ethereum, you tell me. I mean, you can see, let's put it this way. If you see this smile confirmed, then we've got trouble. But until that does confirm, I think all this is a trading range. Yeah, we're up, we're down, we're up, we're down, we're up, we're down. 50% of the range is right in this area. 50% of my anticipated move stop to scratch. That's why I did move my stops to scratch yesterday. I wouldn't be surprised. There's 2.618. That should be traded too. 4.669, a revisit of these lows and see if we can freak some kids out. See whether we can get them to panic sell. That wouldn't surprise me, but on balance, this looks like a trading range to me. This does not look like a bear. So to finish off that thought, as I had said earlier, if you have a market that seasonally, of course, sell in May and walk away, usually we have a bit of a tough slog in the month of June. There's big European regulations that are coming into the market here near the end of this month. There's tax loss selling a deadline for people down under into the end of the month. There's lots of reasons for this market to go down, but it's not. So what does that mean when we actually get back into a market state when the market actually should go up? Oh boy, be careful. Maybe don't marry the short trade that much, because I'll finish off the video with just a quick look at where is it over here. Try and remember, and if anything, I didn't mention this earlier, but it's a good segue. If I can find the damn image, there it is. We have to remember where we are in the money cycle. So the money cycle is this sine wave. Basically it's a 4-year economic boom, interest rates going up, sine wave growth. This is the 2-year bond that I was telling you that often tracks very closely with the Fed funds. We used to follow the euro dollars, but of course that was too good of a tool. So the powers that be took away the euro dollar market, bastards. So we're stuck with using the 2-year note here for our sort of market-based proxy. But you can see, bond prices up. That means interest rates down. So this was the dot-com bust. This was Junior Bush's economy. manufactured wars that got the economy going again, weapons of mass destruction that they never could find. Don't tell me the 1% doesn't manipulate our society. Oh boy. But you can see how we just follow along the sine wave. So then we hit sort of the peak economic cycle. Then, of course, we go into the great financial crisis. And a lot of you that are probably watching this video and even participating in the marketplace, this is kind of like the only world that you're aware of. You probably don't even remember the dot-com days. But anyway, the point here is that when this was so bad that there was no interest rate increase cycle on this part of the sine wave, this was it. You can see the outperformance by the bond market. And unfortunately, I think a lot of people in our society kind of just sort of got used to, well, interest rates are supposed to be zero. That's what's supposed to happen. And this is actually extremely abnormal. Then Mr. Trump comes into power here, and you can see, put a lot of policies in place that I think really helped the United States of America. I think also, too, relatively good timing on his part, more probably luck than anything else. Obama basically rode out the horrific part of the cycle. Then, of course, you remember Mr. Trump was going to fire Jerry. You have been summoned to the White House to have official meetings with the president about why you are keeping interest rates as high as you are. And really, I might even argue that the Fed kept interest rates a little too high, a little too long, because the cycle was supposed to turn here. And all of a sudden, mysteriously, we had this sickness just mysteriously appear out of nowhere. And boom, they took rates down and basically obeyed the interest rate cycle. Then, of course, we went through the whole sickness nonsense. Bond prices went through the roof. And, unfortunately, we had basically a socialist. I mean, Biden's unabashed socialist, maybe even borderline communist. The CARES Act just absolutely blew up the U.S. balance sheet. And of course, at the same time, too, Mr. Trump and Mr. Bush cutting taxes. In fact, I think even Obama even cut taxes on the rich. So it just has made the United States just a disaster when it comes, and all these Western countries, with not only the insane money printing and debt printing by these governments that don't have any of this money at all. At the same time, too, they're cutting taxes on the rich. And of course, they have all these crazy real estate loopholes that the rich, if you're in the real estate business, you got basically guaranteed you don't have to pay any taxes ever. So now we're on sort of the other side of that. So the Fed, you see the money cycle. So really, it shouldn't surprise us that rates had to go up. But here we are down at the trough. So what happens now? And I might argue that some point in the not too distant future, rates have to start coming down. And in a weird sort of way, you heard that from a lot of the reporters. They just kept talking about, okay, when's the next rate cut? When's the rate cut? When's the rate cut? When's the rate cut? When's the rate cut? I think at some point, Jerry's going to have to acquiesce. I don't know whether it will take as long as it took through this last cycle for the Fed to actually turn back up. But you can see, at some point in the not too distant future, we should start seeing interest rates fall. And I think what has to end up happening, and I would disagree with Mr. Powell, he had said there, remember the reporter, I can't remember what agency she was from, a very, very astute, and you even heard me come off mute and I went, touche. And she's like, well, you're going to wait for the labor market to break before you can seriously start cutting interest rates. But the labor market's a lagging indicator. So doesn't that mean, because it's a lagging indicator, that the market will already break and there will be a major problem before you act? And he was all like double talking and sidestepping and all that. And he tried to avoid her question, and I thought that was very, very smart on her part. She was a smart cookie, no doubt about it. I can't remember what her name was. I really liked her. Not the CBS reporter. That girl, oh my goodness, get her out of that room. She did not know what the hell she was talking about. Anyway, so the point of the matter is what is it that breaks, that causes the labor market to crack, and then the Fed will actually start raising rates or lowering rates, beg your pardon. Please, for God's sakes, don't tell me it's another one of these goddamn manufactured crises. I really hope it isn't. I would rather us go back to a world of we can trust our government officials. We live in a world of equality. But, you know, what I've seen over the past 5-10 years, and especially through this whole sickness, I mean, you saw him continuously lean on, well, it was the pandemic. Oh, it was the pandemic. Oh, it was the pandemic. No, it wasn't. Actually, this is exactly what was supposed to happen. You were supposed to have rates go down. But you know, were at odds with this gentleman. And so as a result, you avoided it until the absolute last moment. And then, of course, then he comes out and he goes, oh my God, you better do something to save the economy. Remember in March of 2020, and he was like, you absolutely have to do something. You have to do something. You have to spend money. You have to pass, you know, emergency bills. And, you know, he works people up to the point where they go, I will sacrifice my life to save capitalism. It didn't have to be that way. So very irresponsible as far as I'm concerned. But anyway, so the point here is something's coming. There's no doubt about it. We just have to wait for it to break. And my fear is, and I'm actually starting to hear people talk about a new sickness is being manufactured to probably do this all again. Anyway, we'll see how that goes. Okay. I think I'll probably leave the rant at that. As it stands right now, I think that they've gotten in front of this inflationary problem. I just don't think that we have enough data yet. Like this M just confirmed. I think, you know, like Jerry was saying, you know, through the first quarter, we saw this turn back up. And so as a result, we paused. You're probably going to have to see, you know, as he even said, you know, we are going to have to see repeated prints that this is okay. I think you're going to get that because you know who wants to keep his job in the White House. And I think he's doing everything in his power to try and knock this oil price back down to earth. And as I've said repeatedly, you want to know what the inflationary push is in our society? 9 times out of 10, it's energy. But what do we see happening here over the past few days? So you really want to know what's going to happen with inflation, just follow the energy price. It's that simple. Okay, I hope you all got some value out of this, and then put a little bit of context of sort of what I'm seeing, bigger picture to help the conversation. So, and if anything, what I want, yeah, okay, you know what? I'm going to stop talking now. All right. Have yourselves a great day, everybody. I hope you enjoyed the frivolity. I don't know whether I want to get too wrapped up in being too bearish of crypto now that we've already dumped and we're now back against these lows again. So what I'd like to see is I'd like to see my profit objectives get hit here on this Ethereum short, and then I can just sort of sit on the sidelines with my stops at scratch on the runners. So maybe I could see big Ethereum come off a bit more here. We'll see. Okay, have yourselves a great day. All the best. Hugs and kisses. Chris, if you could take us on out of here. The only thing left for Brian to say to you all is bye for now.